BTIG's Jonathan Krinsky says the potential for a pullback is elevated. Tom Lee says stocks are going to rally post FOMC. What do you think?
So I think as we move towards the end of the second quarter and mid-year, you have this looming battle between resiliency and complacency. Do we have a resilient market, or is there too much complacency in the market?
It can be both.
We
do have a resilient market. You could still have complacency.
Well, but think about from a perspective of positioning. If you're in the resilient, I don't think you can be in both camps in terms of positioning. I'm in the resiliency camp. I think this is a resilient market, and we continue to march higher towards the all-time highs. The problem and the challenge, as I see it when I do the analysis for myself, is now we're heading into a moment in the calendar where you lose the buybacks. You know that the 90-day extension on the tariffs, that's coming to ultimately an end. And then you have this FOMC meeting this afternoon. And I think that everyone is really treating this meeting with a degree of, oh, okay, it's just going to be a boring meeting. Nothing's really going to happen. If Chairman Powell really has a hawkish position, and I can't see why he would move towards a dovish position, if he remains hawkish, I just don't see that being good for markets.
I don't know why he would remain hawkish, Bill. You get jobless claims are elevated. You've had some data points that are weak. Retail sales, biggest drop since March 23. Now you could say, well, that's all pull forward. And maybe it is. We get it. Home builder sentiment is bad. It remains such, even as rates have started to come down a little bit. What do you want to hear today?
I think he has a reason to go dovish. I think the city surprise index has continued to come down, lowest since 2023. But more importantly for me is the Michigan consumer one-year inflation expectations. Now, it is a politically divided survey, and it was leading with the Democrats. It was very high, elevated to 7.3%. And I called that a cycle high. I've been calling that a cycle high for a bit. That May number was revised down to 6.6. The June number just came in at 5.3. And this is important because the Fed believes inflation, consumer inflation expectations are a self-fulfilling prophecy. And I think they do believe that amidst tariffs, that inflation could become unhinged because of those expectations, and it's coming down now.
Yeah, I don't see how he, now maybe he does, I don't know, but the economic surprise index, the most negative so far this year.
Agreed.
I mentioned the data points.
Agreed.
Inflation readings of late have been pretty good.
Okay.
So why do you think he would be hawkish in the face of all of that?
Because we still have looming tariffs, and now we have a conflict in the Middle East in which we don't know the result. We don't know where oil price is ultimately going to go. So he has that uncertainty in front of him. I'm not sure his disposition can move towards being dovish. I think that the eco data is suggesting that he should make that pivot towards being dovish. I see that we have an economy that is beginning to slow from a higher level, but I think there is too much uncertainty in terms of the policy in front of him for him to move in that direction.
I don't even know if uncertainty equates to being hawkish. It just is what it is. What do you think?
I mean, I can make a case that we're already too restrictive and that we should be cutting this week. Now, that's not going to happen, and I in no way, shape, or form am expecting that because of the tariffs, because of the bump in oil. But if not for that, you look at this market and you can make a great case that we should at least be having the conversation about rate cuts. We also get a dot plot this week, which will be super exciting for those of you at home that pay attention. And if that's only one cut in the dot plot, I think the market's going to be very, very negative. If it's two, I doubt it would be a positive catalyst. I think that's already priced in.
Yeah, well, we are going to get the outlook, so that's going to be key. Steve Weiss joining us today from the hole in Alcatraz, obviously. Nice backdrop. What did you do to get put in there, Weiss?
You know, I'm actually sitting in the office of one of our portfolio companies, Nibble Robotics, that's fully automated.
Do they
warehouse.
make bricks?
They don't make bricks, but they have very austere, which we like to see from companies, not building monuments, but working out of austere surroundings. So what you don't see is the 100 engineers working here. But here's a data
we'll take your word for it.
Yeah, here's a data point that hasn't come through. Nimble's costs for aluminum, which they used to source from China, went up 50%. So they now source completely from the U.S. What they're able to do is save a little bit. So their costs are still up on aluminum, forgetting about all the other raw materials, 35% year over year. Now, this is just one company. So I would go back to what Joe said, and there's another category, and the other categories which I'm in is resilient but very nervous because of where we are. We're at elevated valuations on the market. I don't think that inflation, I think the market's been very sanguine about inflation based upon the last two reports, but I think that's coming to an end and quickly because inventories that were not tariffed are petering out, and now you're going to have to pay the higher prices going forward. And you're right, Scott, there's no basis for Powell to be hawkish in this report, and they do have a very, very tough situation. They're not going to predict war, so I don't think they're going to talk about war in terms of what it would do to oil prices, which has spiked them up, nor will oil prices rising be a demand factor, so it won't be indicative of a stronger economy. So I think basically it's status quo. I think the dot plots don't really change, and I think if the market sells off because of one dot instead of two cuts, that you'll see a snapback rally. This is a market that just has pure momentum. It's got momentum in basically every sector. We're seeing the appetite for IPOs, and I think remains strong until we get to the second quarter earnings report. And I think that's going to be the tell on the market. Will it continue to be resilient, or is it going to give back some of the gains? I'm sort of in the latter camp, but then again, with the companies I own, I'm not really positioning differently because they're permanent compounders for the most part. On the edges, I may make some changes, but otherwise I'm staying where I am.
The status quo comment implies that we could hear uncertainty and patience a lot today as Steve Liesman sitting in the room later listening to Chair Powell. So what is the over-under, do you think, on the number of times we're going to hear uncertainty or patient today, Steve?
I think it was 9 in the last one, but I just love this conversation. You, Scott, just engineered a perfect stagflationary conversation, which is almost precisely what's probably going on around the table at the Fed right now. You have guys like you, Wapner, who said, hey, look at the claims number, look at the housing number. How can we not be cutting? And then other people come back and say, yeah, but you have the inflation problem, the tariff issue coming potentially down the road. Which should we address? Interesting to go back and look at both the number and the change in the March forecast, Scott. And that was that initial stab or step towards stagflation. Look at that. The core PCE went up by 0.3. Real GDP went down by 0.4. And what did they do with the funds rate? Well, they kept it unchanged, 3.9%. One other thing that I'm going to be looking at today, Scott, we don't talk a lot about this. We talked about this a little bit yesterday. But how certain or confident is the Fed? If you look at their own measure of what they say they don't know, or their own measure of confidence in their, for example, their core PCE number, take a look here. The number is 0.89. That's their uncertainty, where 1 is maximum uncertainty. 1 means that every official is more uncertain than usual. Where are they? They're just a tick below they were with the pandemic. They're a tick above where they were during the great financial crisis. When do you think the Fed's going to cut? Well, watch when that number comes down, when the Fed gets more clear about the outlook. So I would say if the president wants the Fed chair to cut, maybe call him stupid less and create more clarity in the tariff outlook and the regime more.
Well, just that, what you showed, that chart, just underscores why some think that the dot plot in and of itself, or even right now, is comical because it virtually means nothing. Like, what difference does it make that you have the median Fed person saying, well, we have 2 cuts coming this year, while at the same time you've got Powell saying 4,000 times uncertainty, uncertainty, patience, patience, patience. How can both coexist?
Well, I think what you want to know, Scott, and that's why we are able to do interviews with Fed officials, why they talk publicly, is what underlies that outlook. When they say 2 rate cuts, is it expecting that the tariff inflation will pass through the economy, be a one-time event? Is it an expectation that the job market will weaken? Is it an expectation that they need to get back to neutral, or will there be something more that they need to do here? And that's why I think what's been interesting is to watch the job market, which did have a decent number the last time around, but you had those big downward revisions. You've had claims tick up 240, 250. That's a higher number, but it's not an especially worrisome number. When I look back at the history, Scott, 300,000 seems to be a number that is more concerning and indicative of the employment market about to roll over.
Yeah. All right, Steve, we'll see you in a bit in the room where it all happens, and we'll talk afterwards, of course, as we always do, as Gunlock's going to join us on Fed Day as usual.